This is an example problem that will work us through the accounting cycle for Pharrell Music Services. So on January 1, the company issued common stock for $76,000. When you issue stock, you almost always issue it for cash. Probably should have put that in there. So that means our cash increases. Our cash is an asset. So to increase an asset, we have to debit. So we know cash goes here for $76,000. Common stock, I'm going to abbreviate here because it takes up room, and these are just my little notes anyway. Stock goes up. Common stock is one of those 3 stockholders' equity accounts. So to increase stockholders' equity, that's a credit. We kind of could figure that out just because we knew the debit. But it's good to think through each side of it and make sure you didn't do anything screwy along the way. And this would be 1-1. Pharrell used a portion of the money to buy a building. Again, we used money, that's another word for cash. So we know the cash is going to decrease. That's an asset. So to decrease an asset, we're going to have to credit that account. We buy a building, which also is an asset. And so we want to increase that asset. To increase an asset, that's a debit. So I didn't give myself a date. We'll say this was on 1-1 as well, since that's kind of indented funny. So we're going to take cash and credit that. So that has to go on the bottom line for $51,000. And we get a building for the $51,000. So you could start with the building, doesn't make a difference which one you do first, so you get them all in the right spots. So on January 2nd, they borrowed some money to buy some music stands and other equipment. So on 1-2, they borrowed money. So that if you see the word borrow, that means it's a liability. So our liability goes up. To increase a liability, you credit. They bought some music equipment. That's an asset. To increase an asset, you debit. Again, you can do whichever one you remember easiest the first. So equipment goes up for $34,300. A liability always ends in the word payable, so I could call it loan payable or note payable or anything you want to call it for me, just as long as you end in a payable, so I know you know it's a liability for $34,300. So then on the 6th, we purchased some supplies for $200. So this is paper and cash register tapes and that sort of thing. If I tell you the word on account, that means it's an IOU. That means we didn't pay for it. We, put it on our Office Max credit card, and we're going to pay for it later. So the supplies, you can do it in any order. I'm going to do the supplies first since that's easiest. The supplies, again, they're an asset. There's something you own. We're going to increase those by 200. So that's a debit. We purchased on account, so we didn't pay for them. So this is another liability. I owe that. I want to increase my liability. To increase your liability, that's a credit. So this is on the 6th. The debit was the supplies account for 200. And my liability, usually if it's normal things that you buy, you call it accounts receivable or accounts payable. Oops. And again, make sure you use the word payable there. And that has to be 200. And that's your liability. So that means you got some supplies, you're going to pay for them later. I got a lot of lines here, so this must be a complicated one. On January 7th, I paid some rent. And I paid to run an ad in the newspaper. So I'm going to do this the long way. You can do it in one entry, but I'm going to do it the longer way. So these are really two separate things. I just did them on the same day. So my rent, I pay that just for the month. And so this has to be an expense. And even though I'm paying it a little bit in advance, it's just for the month of January. And so again, that's a cost of doing business. So that's my expense. To increase your expense, you debit it. And I paid cash. So again, cash is an asset. I'm going to decrease that. So that's a credit. So that seems to make sense. I got a debit and a credit there. I've got an ad that I'm running. So that's advertising expense. It's a cost of doing business. And again, the nice thing about expenses is they tend to end in the word expense. So that's an expense that I want to increase. To increase the expense, you debit it. And again, I paid cash for it. So that's going to reduce that asset to reduce cash to credit. So I gave 4 lines, so you can do it in 4 lines. So we're going to do it that way. So on the 7th, we have rent expense. And make sure you put the word expense here because there's no such thing as rent. So we need to know that that's rent expense. It means you used it up. And cash for the 1,100. And then we don't have to repeat the date if we do it all on the same day. And then we have advertising expense and cash for the $500 for the ad. All right, so January 15th, I'm going to pay my employees. Your employees worked for you, so that's another expense. So we'll have salaries expense, which obviously is an expense account. On exams, it's really hard for me to hide an expense because it's got the word expense on there. And there's no such thing as salaries or payroll or weirdo accounts like that. It always has to have the word expense on there. That goes up by $2,200. And as I said before, the expenses almost always go up. So you almost always debit. Later on, we'll find a time when that hasn't happened, but almost always. And then if we just paid them, we must pay them cash. Sometimes you owe them and you pay them later. Here, if it says paid, it means you get them cash. So we reduce our cash, which we know is credit. Again, sometimes I'll do that first. And that way I don't have to think so much about it. And then salaries expense or wages expense. Sometimes in your problems, they'll call them wages. Goes there. Now we start actually making some money here. Student comes in and I give them some music lessons. So on the 19th, I gave a music lesson to a customer and they gave me $1,400 cash. So again, cash is easy. Cash increases, that's the debit. I'm in business to give music lessons. So this is where I've got revenue. I've made some money. So again, I'm going to call it revenue. Sometimes it's okay if you call it sales. two names for kind of the same account. But when revenue goes up, that means we credit the account. That's the one people have trouble with. So sometimes, again, it's easier to start with that cash. So I've got cash of 1,400 and revenues of 1,400. So that's what I mean. A debit or a credit isn't particularly a good thing or a bad thing. If I'm crediting revenues, that's a good thing. If I'm crediting cash, that may not be so good. So that would be on the 19th. So the company also repairs musical instruments. So the company repaired musical instruments for a local school district, so it's a bunch of instruments. On January 21, the school picked up the instruments and a bill for $3,600 for services rendered. So they didn't pay us, they just promised to pay us. So since we just did revenues before, I'm going to do revenues. You can do this in any order. But since this is for services rendered, this is what we did for them. Our revenues need to go up by $3,600. So like we just said, if we increase revenues, I'm going to spell it out, we get credits. The debit then, they didn't give us cash. They gave us an IOU. So this is an asset. We call it accounts receivable. I before E, except after C. And to increase an asset, we, up arrow, we debit. So we have revenues for $3,600. And this is accounts receivable. I'm going to abbreviate a little bit because I never remember the I before E and I get tired of saying it in my head. 3,600, and that would be on the 21st. So if I compare these two, notice the revenues are exactly the same. If I get them both on the screen here. Revenues are exactly the same. We credit, and then the debit is either if we get cash, it's cash. If we just get the promise to pay, it's accounts receivable. So those, when you have revenues, basically it's one of those two entries. Either they pay you or they don't pay you, but they promise to pay you in the future. So on the 23rd, the school district paid $100 towards, oh no, this is Pharrell. Paid $100 towards the supplies they purchased. So if you remember, we're way back here, and see, we bought these supplies and it was an accounts payable. So I'm going to pay $100 of that off. So after I'm done, I should only owe $100. But notice I recognized all the supplies here. So when I pay the accounts payable, my supply account's good. I don't want to mess with that. All I want to do is fix the payable side. The payable is a liability. I want to decrease that payable. So to decrease a liability, it's a debit. This one, again, is sometimes easier to do the cash first. Cash is an asset. I'm paying people, so my asset's going to go down, so that has to be the credit. So a lot of times I'll just put the cash here first because I know I paid cash. So this got to be something else. I'll pick something else. But it's the liability that goes down by 100. So if you think about it, I'm going to do a little T account. I'm not sure if you've already viewed the T account thing. But if I looked at my accounts payable, that earlier entry I put 200 in. Here I reduced it by 100. So now it shows that I only owe 100 on that accounts payable. So when my check writing person comes up, They know to pay just $100 more, not pay that whole $200. Next, there, on the 26th, we received a bill for our utilities, but we're not going to pay it until next month. So it's for utilities that we've already used. So this is going to be an expense. We need to increase an expense. That's a debit. We're going to pay it next month. So that means we're going to have a payable, which is a liability that we're going to increase. And so there's our credit. So, and again, always put the word expense after here. There's no such thing as utilities. How much are we? $700. And some kind of payable. We could call it accounts payable. Sometimes you have a special one, and I'm going to use this here for utilities. And that's just up to the company if they want to keep that separate or not. And so we might even call it utilities payable for $700. And that's why you can't just use the word utilities. I need to know it's an expense or it's a payable, two very different things. Next, we received cash from that school. Okay, so I'm going to back up here. This was G on the prior page, where that school district we did all that stuff for $3,600. And remember, we put it in accounts receivables. We recognized the revenue earlier, so we don't want to play with revenues again. All we care about is this cash thing, and we received cash. We received cash, cash goes up, cash is an asset, that's a debit. Where did we put that IOU? We put that IOU in an account that we called accounts receivable. That also was an asset, but now we're going to reduce it because they don't owe us anymore. We got the cash. And so to reduce an asset, that's a credit. So on the 28th, we get some cash for $1,900. And we're going to get rid of the accounts receivable for $1,900. And again, I'm going to do a little T account just to show you what's going on here. So my accounts receivable, I had that $3,600 that I put in on the 21st. Now I'm taking out $1,900 because they've paid for it. So that means, see if I can do math in my head. They now owe us $1,700. 7 plus 9 is 6. I think that's right. So now I know that I only have an IOU left from them of $1,700. All right. So the 28th, I decided I'm not only going to give lessons and do repairs, but I'm going to sell equipment. So on the 28th, I was busy on the 28th. They, and again, they means Pharrell, bought 5 guitars for $100 each that I'm going to sell. So I'm going to sell some guitars as well. So, but I haven't sold them. I just got them in the store. So again, start with the easy thing, cash. I shouldn't have to put this anymore. You should be saying, I know, shut up. You'll say that quite a few times during this semester, I bet. So I need to reduce my cash, but I'm going to increase my inventory, which is also an asset. So that means that has to be a debit. So inventory goes here for how much? $100 times 5. I hope you can do that in your head. $500. And that's how much cash I paid. All right. And this is kind of the new part we haven't really talked much about, so we'll think through it. So on January 30th, we sold one of those 5 guitars. Now, do we want to sell it? me get all this in here. Do I want to sell that guitar for $100? And the answer should be no. You're never going to make any money. You got to sell it for more than you paid for it in order to make money. So we're going to sell it for $250. And so for every guitar we sell, we're going to make $150. Okay, but we only recognize the revenue when we sell it, not when we put it on the shelves. Nothing, we don't have revenue at that point. What happens on here? We've got a whole bunch of things that go on. We're going to start with, we're going to sell it for $250. Okay, so that means we're going to get cash. We're going to increase cash by $250. That's an asset, so that's a debit. We're getting that because we sold it. And so we get revenue, we increase our revenue by $250. And that's a credit. And you can call it sales if you want. But something else happened too. After this happens, the person walks out with our guitar and we don't have a guitar on the shelf anymore. So we have a second entry we have to make when we have a sale of something that's considered inventory. Because the other thing that happens is now the inventory goes down, because now I only have 4 guitars. Inventory is an asset. So to reduce inventory, that has to be a credit. You didn't know the music, the paper made noises. And the other side of that is I have an expense because to make this $250, I used up $100. Okay. So I need to increase an expense, which is an expense. And so to increase an expense, we debit it. And we do those things for not the $250, but the cost of the guitar. So $100 is the expense and the inventory. Okay, so 2 steps when you make a sale if you're selling merchandise. So on the 30th, you can do them in either order, doesn't make any difference to me, just get them both done. We've got cash and we have revenue. I'll put sales in here just if you like that name better, whatever sticks in your head. For the $250, that's the amount of cash I got. But then my inventory also goes down. I like to do that one next because that makes the most sense to me. And it goes down by 100. And this account here is the one expense account that doesn't have the word expense in it. But it's the cost of the goods sold. And that's the 100. As I said, as accountants, we're not too creative. That's the cost of the goods you sold. That's the cost of the inventory. So in essence, to figure out if you had a profit, $250 in revenues minus your expenses is your profit. And that's where those revenue and profit are 2 different things. So $250 minus the 100 means I made $150 on that guitar. And just to do another little T account to see that this makes sense, the other reason this is important, our inventory up here was $500 because I had 5 guitars. I sold one of them. So now I know I have 4 guitars left with a cost of $400. So the whole point of double entry bookkeeping is you kind of know what's going on as you're going, and you never have a negative sign, and you can follow along and see what's going on in your company. We'll come back to that problem and do financial statements, but that's how those journal entries work. And hopefully when you're done, you should be able to go back and look at this entry and say, oh, I sold something. And look at this entry up here and say, okay, it hits inventory. I must have bought inventory for cash. Sort of like Jeopardy, where you can come up with the question given what the answer was.